What is WACC? How to assess whether to invest in a new capital project or not? These were some of the questions that were answered in a course that we took called Financial Management. Hi, my name is Arjun Chaudhary and welcome to Mission Happiness. Let me share a few concepts that we had learned from this course. Firstly, capital structure of a company. Now, when you have a company, in order to continue its operations and grow, it needs funds to come from somewhere. Some of these funds comes from its profits or net income. However, some of these comes from debt and equity. An example of debt would be taking loans from banks. An equity would be when investors purchase shares of your company. The funds that comes from there is equity. The proportion of funds that comes from your debt and from your equity is what is defined as the capital structure of your company. Now, a company that has a lot of tangible, physical and capital assets would have the capital structure more leaning towards the debt side. This is because they have all these tangible assets. Banks would be more prone and willing to give them loans. However, if your organization has limited tangible assets and is a more service-based organization, your capital structure would be more leaning towards the equity side because banks would be hesitant to give you loans. Now, a financial parameter that is directly tied to this capital structure concept is called the WACC, weighted average cost of capital. This is essentially the average cost of capital from all fund sources such as common stock, preferred shares, bonds, notes, loans. Typically, the WACC is between 8 to 15%. Now, how can you use this WACC to determine whether a company is in good shape and performing well or not? Well, what you do is you compare this WACC to the net profit margin of a company. If the net profit margin of your company is greater than your WACC, your company is in good shape. However, if your net profit margin is less than the WACC, there could be some concerns. So let's say, for example, in 2021, your annual profit margin for the company was 12%, but your WACC was 14%. Now, because your WACC of 14% is greater than your profit margin of 12%, there could be some concerns in your company. Next, let's look at capital budgeting tools. Now, when your company is considering to invest in a new capital project or not, the CFO of an organization, Chief Financial Officer, has a variety of capital budgeting tools that they can use to determine whether to invest in a new project or not. These capital budgeting tools are net present value, NPV, payback period, internal rate of return, profitability index. So let's say, for example, your company is pondering whether to invest in a new project or not. The CFO of the organization asks their financial analyst to go and calculate the NPV and payback period for the project. We'll look at NPV and payback period because those are the most common ones. Now, your financial analyst does their calculations and everything, and they come back to your CFO stating an calculated NPV value and a calculated payback period value. NPV, net present value, is essentially the difference between the present value of the cash inflows and present value of cash outflows over a given period of time. The rule is that if your NPV is greater than 0 or positive, you invest in the project. And if your NPV is less than 0 or negative, you do not invest in the project. Next, payback period. This is essentially the number of years that it takes to recover the initial cost or the cash that you've put into the project. So every time a company is deciding to invest in a new project, they have a cutoff payback period. So let's say, for example, in our case, the cutoff payback period is 3 years. So your company says that within 3 years, I want to recover all my cash that I've invested in this project. Now, the financial analyst comes back with all the calculations and says, well, I have calculated the payback period of investing in this project to be 5 years. So the rule is that if your calculated payback period is greater than your cutoff payback period, you do not invest in the project. But if it's less, if your calculated payback period is less than your cutoff payback period, you do invest in the project. So in our case, because our calculated payback period of 5 years was greater than the cutoff payback period of 3 years, we will not invest in the project. So there you have it, ladies and gentlemen. Some of the concepts such as WACC, NPV payback period that we had learned from our course Financial Management. Remember, happiness is the key to success. I'm Arjun Chaudhary.